Hello and what is going on, lovely people of the internet? It is Hoop Money here with another video for you guys today. Today we're going to be going over Senseonics stock, ticker symbol SENS. Guys, this stock is a very disruptive company trying to use continuous glucose monitoring and trying to commercialize this to help diabetic patients. So I did a lot of analysis on this stock, probably about 5 or 6 hours of research. I went through it all. I learned the company. I learned what they're doing. I'm learning what might drive up their price in the future. I learned about the risk involved in buying this stock. I analyzed in depth their financial statements in their recent 10K filing that they filed in the beginning of March. Guys, I'm sure you guys are going to like this one. And if you guys want to see any more analysis like this, in-depth analysis, not some fake YouTube, this thing will rocket soon, blah, 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 short squeeze, blah, blah, blah. This is a real financial analysis video. So if you want to see more than that, subscribe to the channel, turn on post notifications, and don't forget, the number one thing you can do for me is like the video, because liking this video helps promote my content to other people on the internet, on YouTube, and it's very, very helpful. So yeah, the number one thing you can do is like the video. And that all being said, I'm gonna get right into this video, so let's go. Oh yeah, one more thing. Someone actually requested that I make this analysis on this stock in the comment section. So make sure, if you guys want to see me do an analysis on the stock you guys own, make sure you leave a comment down below, and I will make sure to take a look at it and see if it's worth making a video on. Senseonics is a medical technology company that is focused on developing and commercializing long-term continuous glucose monitoring through implanted systems. This system, or CGM, which stands for continuous glucose monitoring, will improve the lives of people with diabetes by making it much easier to manage their disease. They have two systems in place, SENS and SENS XL CGM. Both are designed to accurately measure glucose levels via an under-the-skin sensor, a removable, a rechargeable smart transmitter, and a convenient app for real-time diabetes monitoring. Their technology monitors diabetes levels for 90 to 180 days compared to only 14 days for non-implantable systems. Currently, they have FDA approval for their 90-day system, but they are seeking FDA approval this year for their 180-day system. They are expecting FDA approval for their 180-day technology no later than the second half of 2021. And with this approval, they expect to begin transitioning patients in the United States to the 180-day SENS products. Once they get the 180-day product approved, they will start seeking approval for their 365-day product. They currently have a strategic partnership with Essentia, a leader in blood glucose monitoring with a heritage of almost 80 years of innovative diabetes care products. Essentia has products in over 125 countries, and they continue to help over 10 million people per day. Essentia currently has over $1 billion in global sales per year, and they're committed to making material investment into the commercialization of SENS. This partnership will essentially allow for the SENS technology to be scaled and more commercially adopted. Currently, Senseonics has a limited commercialization experience, and therefore they are heavily dependent on Essentia. The current continuous glucose monitoring market is currently $5 billion today and currently growing at a 35% compound annual growth rate. This means if Senseonics is able to get a huge market share of this market, they will be worth a ton of money. They are predicting a large amount of revenue growth in the coming years and up to 200 million by 2025. Now, these numbers involve a few key assumptions that we will be going over in the risk section. They will be targeting individuals who are not currently satisfied with their CGM technology, which is 68% of the market, and then also individuals that are new to the market, which is 32%. They have competition with Dexcom, Medtronic, and Libre. However, these systems are not nearly as effective and only go up to about 15 days of continuous monitoring, and it's not an implantable system. It actually stays on the outside of your skin. So obviously Senseonics has the edge with their SENS technology, and that's why I think they actually will have a large moat in this industry. They also have had commercial and Medicare coverage since 2018, with coverage for over 200 million lives. The main catalyst that we'll be looking for in 2021 is their FDA approval, which should be coming before August 31st. The FDA will assign a reviewer, and their pre-market approval will come no later than April 15th, 2021. So that's also a date you need to look out for if you're invested in this stock. Now, given the recent success of their clinical trials, which recently came to a conclusion, they should be getting FDA approval without a doubt. And by 2024, their Freedom system should have coverage for everyone, including non-insulin patients, and therefore they will be able to attack the entire market with their technology. Now we are going to be getting into the risk factors section. So this part is exciting because there actually are few risks with investing in this company, which we're going to go over right now. So the first risk factor is that they are completely relying on Essentia to help them commercialize their product. They won't be able to do it without them, and their agreement with Essentia can be terminated under a variety of different reasons. One of them includes if they do not get FDA approval by August 31st, 2021, which I think it's pretty likely that they're going to get FDA approval. I really can't see them not getting it. If they do get approved before August 31st, 2021, you can expect the price of their stock to significantly jump for at least a short period of time. But if they don't get FDA approval by August 31st, 2021, you can expect their stock price to suffer greatly because now their partnership with Essentia is at risk. This company only has one revenue stream, and it's highly dependent on the success of SENS. And like I've said in my other videos, it's very risky to have only one product, because if this product fails, if there's some unknown risk with this product and it does not get FDA approval, if it doesn't get adopted by the masses, if a competitor comes in and slashes them away, then this company will have nothing left. And like I've said before, it's important to not have all your eggs in one basket. So that's something I'm going to be saying a lot on my channel with these companies that only have one singular product. If you look at a superstar company like Amazon, they have their e-commerce website, they have grocery stores now, they have Amazon Web Services, they have so many different revenue streams, and that's one of the reasons that it makes them a great company. They have eggs in multiple baskets. Another huge risk is that their revenue decreased to 4.9 million in fiscal year 2021. Now we compare this to 21.3 million in fiscal year 2019, and that seems like a huge decrease in revenue, and we have to look into why this happened. Now, what the company reported is that there was a huge decrease in sales of their SENS system outside of the United States. Now, the company did not say that COVID-19 was the reason this revenue decreased. When I read through their 10K filing, they did not say that at all. However, there are plenty of reasons why COVID-19 could negatively affect this business. I just needed to mention that they did not mention it in their 10K filing. The company also mentioned that they incurred significant losses over the past few years, and they do not think that in the coming years they will become profitable. And they said that they mainly plan to finance their operations through equity offerings, which is not good for you as a shareholder, and then taking on debt, which could be good for you as a shareholder as long as it's leading to increased revenue more than their interest expense increases. Now, with this in mind, they did have to pay off around $100 million in long-term debt in 2020, so their cash position has suffered substantially, even though they did raise a good amount of equity. And their long-term debt has increased from $12 million in 2019 to now $57 million in 2020. And with this, they went from $16 million in interest income, that is income coming to them in interest, to a cost, to an expense, an interest expense of $57 million in 2020. Now, since their cash balance has gone down a lot and their share price has evidently gone up a lot, I do expect this company to continue to do equity offerings and take advantage of this high share price. They desperately do need cash, as their cash position is low and they need cash to finance their operations. They have also stated that their cash will be going towards research and development, funding their clinical trials, and commercializing their product. They do not expect their product to be profitable within the next few years, and they expect their expenses to go up dramatically. Now, with their increased stock price over the past year, they now currently have a $100 million liability from derivatives and options. So you might think, oh, another $100 million liability. Well, it's not that simple, and technically this should be priced into the stock price already, so you shouldn't worry too much. But when it plays out in reality, what this really does in the end is dilute shareholders. If these contracts are executed, it will be adding additional shares to the float of this stock, that is, shares currently outstanding that are available for being traded. So this could be a risk, as it doesn't directly dilute you, but it kind of indirectly dilutes shareholders as well. And with this dilution, it doesn't actually raise additional capital for the company, and this could actually be kind of hurtful because you're being diluted without actually gaining any expected return. And I do personally think many people who have these derivatives and options will be exercising them, especially if the stock price continues to increase. So my conclusion from all the catalysts and risk is that personally I will not be investing in this stock. With decreased revenues and decreased cash balance, it shows me that this company will be taking on more equity offerings and debt financing. This company definitely requires a lot more capital before becoming profitable, and they will be doing whatever it takes to raise that capital. And I currently don't think that this stock price is justified with decreasing revenue and an increasing stock price. If a stock price is up 300% on the year and the company's revenue has decreased substantially by over 50%, I don't really see that as a great opportunity. And analysts seem to agree with me, with multiple downgrades in 2021, as well as a 32% short float on this stock. Now that short float percentage, that might be the opportunity that you're looking for, as short squeezes have been a very popular thing in the recent months. This stock being a very popular stock among investors and having a high short float makes it the prime opportunity for a short squeeze. And when these short squeezes occur, fundamentals rarely matter, as retail investors decide to buy this stock in bulk regardless of the fundamentals. Long term, however, fundamentals tend to play out, so that is why I'm not personally investing in the stock. Now, if there is a short squeeze, I predict this stock will get back up to $6 a share, and only for a short period of time, because these short squeezes don't typically last. But if the shorts do end up winning, I do think it'll go back down to $1 a share or even lower based on its fundamentals. And if you do truly believe in the disruptive nature of this technology, and don't get me wrong, this technology is very, very disruptive, I think $1 or even less than $1 would be the perfect entry point for you. And another good way to play this stock, if you do want to play it in the short term, is to play the Fda approval, because when this stock does get Fda approval, you can definitely expect a jump in share price. But personally, as a long-term hold, I don't really see the value in this stock, as I know I'm going to get diluted, and I know they're going to have to keep raising debt, and I know that they won't really have the revenue to afford all of this. So it's pretty evident to me that now is not the time to invest in the long term for this stock. But in the future, given a few changes on their financial statements and given a better price point where it's not up 300% on the year, perhaps my mind could be changed about this stock, as it does really do have very disruptive technology. So for the future financial statements, what I want you guys to pay attention to is obviously their revenue going up. We want them to get back to that $20 million a year or more in their revenue, and we want to see that value increasing as we keep going. And another thing we need to look forward to in the future is their liabilities going down. So if they raise additional capital through issuing shares, that could be one way to pay down their liabilities. And also pay attention to their cash balance, because they need that to finance their operations. I've said this multiple times in my other videos, but when a company does need to dilute their shareholders and raise additional capital, it's always better to start investing in the company when they're fully diluted, because as they add additional shares to the float, your expected return from your investment goes down. That's never a good thing. Even though in 2020 multiple times people saw it as a bullish sign, I don't think it's a bullish sign, and I think that a lot of these stocks that did raise a lot of capital, their share price will catch up to them, and that is just a huge risk. And that's why I'm not investing in a stock like this. So here I am on finviz.com, and I will show you guys what I mean. We've been over the price to sales multiple a few times now. 201, that's very high. I like to see around 20, for a growing company, and even 20 is a pretty high price to sales multiple. So when you see something at 201, you know you're paying an absolutely huge premium on this stock, and you can actually see that it's gone from 49 cents a share to 250. So it's gone up a bunch in the past few months alone. So that's definitely a huge risk, and it also shows that you can probably get this stock for a much cheaper price going forward. It's also, you can see right here, it's entered a downtrend. The 50 SMA has crossed the 20 SMA, so that's never a good sign. And usually when that sign happens, it is now battling a new support level, which we see it has found some support here at 250. However, if it breaks through 250, it can likely go back down to $1.14. So that is definitely something to pay attention to if you are owner of this stock, because you do not want to lose about 50% of your capital. So return on assets is minus 448%. So that's basically their net income divided by their assets. And as you can see here, their net income is minus $175 million when their revenue is only $5 million. So you can see what stage this company is in right now. They are pretty much in their early stages. And when you look at their total assets, it's at around $36 million in fiscal year 2020, and that's down from 133 million. So they lost 100 million in assets in 2020 alone, and this number has been decreasing over the past 2 years. So as you can see here, they did use a lot of their cash balance to pay off their current liabilities, which expired in 2020. So it's good that they have that off their plate now. However, now they have a low cash position, so they're gonna have to do something to raise cash so they can invest in their operations. Now they've increased their long-term debt around 45 million. However, that still puts them at 18 million in cash, and they're losing around 175 million in cash per year, 115 million in cash per year. So they're really just not in a great financial position, this company, and they really do need to rely on outside sources to get their cash, which is definitely one of the big risks of owning this company. Now here's the other liabilities. It went from $3 million in 2019 to $103 million, increasing about $100 million. And that's what I was talking about, their derivatives and options. So when the stock price goes up, they actually kind of lose money because now they owe all this stock. But it's already something they own. They already own the stock. It was just some sitting in a closet somewhere, and now they're gonna have to pay it out. But that does dilute you, so that is something to pay attention to. And then here you can see that the total shareholders equity went from minus 8 million in 2019 to minus 141 million in 2020. So you can see this company is losing a lot for their shareholders. This doesn't mean you guys are going to have to owe money, by the way. You are protected. However, this company is definitely going to have to do something big this year, and I think they're going to end up raising a ton of money through issuing new shares. So that's why I think that this stock price may end up going down a bit. However, I don't know. I mean, I don't know how they're going to play this out. They can do two things. They can issue shares, or they can take on more debt. And I think taking on more debt might be an answer. However, they would need revenue because their interest expense has also increased from, they had 6 million in interest income to now owing 60 million a year in interest expense. And it's like, where do they get this money? Like, I don't get it. Like, it just seems like they're just bleeding so hard. Like, it seems like they're just losing so much money. Like, you've seen me show you all of these things. Like, they're losing so much money. Like, how are they going to do it? They're going to dilute shareholders. They have to. Like, they simply can't afford it. With 5 million in revenue, and hopefully that increases, I would think that it goes back to 20 million in 2021 or more. It would have to, or else this stock's gonna go bankrupt, and that's just how it will play out. And then those are the fundamental reasons why there's such a high short float, because of all these reasons. Like, this company is burning money. They are losing money. Their revenue went down by over 50% on the year, and they're supposed to be a growing company. It's very hard to see the value in that. Another thing I noticed in the short-term trade is that right here, their 20 SMA, which is this red line, and their 200 SMA, and this is an hour-by-hour basis, so 200 hours, that just crossed. It's turning into a downtrend. So we're going to need to see some bull power right here. RSI is on an oversold place. So we're gonna have to see some buying here, or else this stock can definitely drop significantly. As you see right here, when it did cross its 200 SMA, it dipped pretty hard, because I guess that's just where all the algorithmic traders get out. However, it did bounce back up, and now it's just been fighting with this SMA line, and it's currently turned into a downtrend technically. And yeah, we'll see where it goes from there. We're going to need to see some bull power. And if it does continue in this downtrend, it'll most likely go to 190. That's where it has a support level. And like I said before, I do think it's fundamentally worth under $1 in share price, just based off the numbers I've seen. So if we get past that 190 level, I think it will free fall all the way down to under $1 to around $1 in share price. I know I'm going to get a lot of hate for this one. There's a lot of people who love this stock. When I was doing research, I looked at a few YouTube videos. People are like very bullish on this stock. I don't even know if they look at like the fundamentals, because when I like watch their videos, they're just looking at like charts and just saying like most YouTubers, I feel like they just look at a chart, they read some articles, and then they present that to their audience. They're not really looking at like their 10K filing and like these financial statements. So like they're not really seeing the financial health of this company the same way I am. And I think that's what really like separates me as a YouTuber, because I'm actually doing the work to looking at these numbers so you guys can see a visual representation of it. And I know it's so hard, and I know I'm going to get so many hate comments, because I always do when I do a bearish analysis, but this is just how I think about this company, and I just don't really see many positives, and I don't really see much value. And if you want to do the minimal amount of work for doing fundamentals on a growth stock, just look at how much the share price has gone up. In this case, it's gone up 300% on the year. It's gone up 567% on the half year. And then you look at its revenue, it's gone down over 50% on the year. Those are the only two things you really need to look at to see if you're paying a huge premium on this stock or not. I personally got really into it, looking at all the liabilities they have and looking at all their financial statements, and I can tell you that there's not much financial health in these statements. However, you can think of this how you want. Just respect my opinion. Don't come after me in the comment section. Don't be a keyboard warrior. I'm simply making these predictions based off of facts, based off of fundamentals, using what I've learned from fundamental analysis to make a prediction, and I've come to this conclusion. So if you want to play this for the short squeeze, just know the risk that you're taking on, and know that this is probably not a great hold if you want to do it long term, because it really could go down to under $1 in value just based on fundamentals alone. So just be careful what you're playing with right now. I'm trying to teach my viewers a fundamental way of investing rather than this stock's going to triple, this stock is going to double. Look at the fundamentals. You know, eventually we're going to come across a multi-bagger investment based off of fundamentals, and we'll know to put money into that. But until that time comes, don't just play with meme stocks because they're popular. Yes, you might make some short-term gains, but if you stop looking at your portfolio and you let the stocks just play out in the long term, you're really taking on a lot of risk, because these companies could potentially go bankrupt. And if you do want to play around with these companies, I highly suggest that you have multiple companies. If you guys are putting 100% of your portfolio into a stock that does not have great fundamentals, and it's just a hyped up stock and a lot of people are talking about it, a lot of people are saying it's going to go to the moon, you guys should not be doing that. You guys should be diversifying if you guys are playing around with risky stocks. This is your hard-earned money on the line. You guys don't want to lose it because you aren't informed of what this company is doing. So sorry about all that. Sorry for my rant. There's just a lot of people who come after me in the comments saying that I don't know what I'm talking about. When I have 2 degrees in finance, like I know what I'm talking about. I know how to read these statements, and I know how a financially healthy company looks. So just don't come after me in the comments. There's a reason the stock's being shorted 32%. It's not because these people just wear their suits and walk around on Wall Street on their high horse. Like, there's a reason for it. This company is burning cash, and if you guys want to invest in like an asset with no fundamentals, like why not just play around with cryptocurrency? With crypto, fundamentals don't matter at all, and you'll probably get much higher returns with crypto, because a lot of crypto, you can't just issue new crypto. You can't just say, oh, 200 more Bitcoin to raise money. A stock like this, there's barely any fundamentals, and they can just dilute the heck out of you. So it's just like, be careful. Anyways, that's it. I'm done ranting. I hope you guys enjoyed the video. If you guys have not already, use the link below to sign up for WeBull. You guys can deposit $100 and you can get 2 free stocks valued up to $1,600 a stock. This is really good. I got about $60 worth of stock from my $100 investment into WeBull. So that's 60% return right there. You might as well do it if you haven't already. It's literally free money. That's going to be it for the video for you guys today. I really do hope you enjoyed. I really do hope you learned something. And yeah, that's that. Peace.